Let's talk to my favourite person in the city. His name is Justin Urquhart-Stewart, and he is from Seven Investment. He was the co-founder. Very good morning to you, Justin.
Good morning.
Now, off air, we were saying, should we talk about this morning? And we were talking about bear markets, okay? How do you prepare yourself if you believe we're going into a bear market, if you believe in baseball stance that we're in the ninth innings? What do I do?
I mean, you're right, we are heading for a bear market. Nobody knows when. This is the third longest bull market since the Second World War. If it lasts until December, it'll be the second longest. But the feature you get towards the end of a bull market is volatility.
Yep.
And that's exactly what we're seeing at the moment. That does not mean we head for a bear market immediately, but it's the signs of this beginning to occur. We've had a very good run. Right. There are various rules which I think you should really take on to manage your way through a bear. It doesn't matter whether that's a grizzly bear or a nice soft cuddly Paddington bear.
And nobody can tell you what a bear market, how bad it is going to be, whether it's 10%, 25% or 50%. We both agreed on that.
Absolutely. You go back to the year 2000, it lasted 3 years, and it could be very painful indeed.
Yep.
But during that time, you could have missed out on some really very exciting opportunities. So preparing for the bear, on the basis we don't know exactly when it is, you've got to be prepared to go back to your basic disciplines of investing, which as an investor means you're not just the private Joe Schmo in the street. That's when to buy, when to sell. So rule one, preparing for a bear, you've got to be prepared to sell something. You've got to sell something because you're going to have some cash behind you. You might have to sell some good stuff as well. Why? Because that's good quality businesses which are likely to be there in time to come when you start buying back into it again. So that's number one. You've got your cash, you're building that position up. Two, you're going to be wanting assets that aren't necessarily linked directly to the equity market, to which the most obvious one is someone like gold. Gold is an unreliable friend.
Yep.
Because it doesn't do anything. You can sick it, you can lick it, stroke it, put it on a pillow next to you. It doesn't give any yield. But it is that ultimate store of value, as the gold bugs love to say. But it does give you that sort of background drop to it. After that, you then got to actually give it time, look when this market moves. And when it starts dropping, and you start seeing some times when these shares are going down really quite significantly indeed, you're going to start looking at times when you start buying in again. So what are you going to be buying into? Well, you'll be buying into, quite often, the stocks you sold, because it's a good quality business. It's still a good quality business. It's just the market has changed. Has that company fundamentally changed? Chances are, probably not. So do you have to buy in all at once? No, you don't. You'll be drip feeding in over the time of that bear market, because that bear market is not going to go down flat and then back up again. It's going to be all over the place. But you'll be able to just be buying those stocks at better value. Next thing you actually be doing is then what stocks you're holding on to, because you don't necessarily want to sell everything. You want to hold on to those stocks which are there to provide you with your regular income, those that are going to benefit the compounding, those with good yields, not those with mad yields, because anyone's got a really mad yield normally means you're heading towards serious trouble. But the ones who used to be the banks, they're getting better now, they're coming back to it, but the oil companies and petrochemical companies, all those ones with reasonable yield, we can get 4% off, and they're probably likely to continue to do so. They all sail through the bear, giving you the compounding still, even though their share price moves. So you're hanging on to that lot, you've raised cash with another lot, and you're buying in, and you're buying into those companies which you think you've had before but want to still buy them again. Second ones, you'll be buying into those which you know but haven't actually bought in before, but look at that value, you're suddenly seeing them at a heavily discounted price.
Okay.
But nonetheless, good quality businesses. And those are the two you should then be looking at. That then, as you're coming out of the bear market, now then you're in a position where you've still got your solid parts of your portfolio still there. Meanwhile, your other stocks, you'll have traded out and traded into again, and effectively, you've now got far better value.
So you are managing your portfolio, but you are having a trader's hat on to an extent that you're saying, I'm going to sell here, close out a position, and then try and go bottom fishing, okay, and then drip into those world-class stocks, let's call them, that have got a good dividend yield.
Yeah, and this isn't the only way of doing it, because as a private investor, you look historically, what's the best thing the ordinary private investor could have done? The answer is nothing. Yeah. Just ignore it, it'll go away. Don't listen to Hugh Edwards on the 6 o'clock news droning on about bad news in the stock market, and that'll be fine. But if you actually want to take a more active view, you don't have to be a frenetic day trader, but you can quite deliberately sit there and take some of your stocks, get some value out of it, and it takes courage to do that. To sell a really good stock, take someone like Diageo, for example. Really good company, but you think that's going to be affected. I'll sell that because I know I'll probably be able to get that at a better price in 6 months or a year's time. And 6 months' time, it's gone down. I'll take a bit now. I'll take another bit in about 18 months' time, and then hopefully things will start picking up again.
Okay, so let's talk alternative assets for a moment. Gold. I saw a headline in the FT recently, gold is old. Okay, well, it's not, it is old, but it's not old as an investment concept. You've got crowdfunding, you've got crypto, you've got Bitcoin, you've got property plays, okay? In a bear market, would you diversify here, there and everywhere?
I would diversify, yes. Now, as an investment manager, it's easy for me to diversify because I can diversify into things which the private client can't so easily do so. So, for example, I've got a fund which is UK mortgages, now, which are totally unlike US mortgages. There's very low default rate in the UK. So you can buy a fund of mortgages and I can get a very good yield out of that. And mortgages aren't affected by the stock market. So that's a nice one to have. Bitcoin and things like that and all the crypto stuff, be wary. These are unregulated markets. You have no idea actually how they operate. Most people don't even know how Bitcoin actually works, including me, totally. And so therefore, you avoid that stuff. That's a fashion fad. Yes, people will say they made a lot of money out of it. Other people have lost a hell of a lot of money on it. So be really rather careful. Crowdfunding, things like that. There's nothing wrong with crowdfunding, except there are going to be some horrors coming out on it. You need one which is a properly run, well-regulated crowdfunder who does a lot of due diligence. There aren't many of those around. So again, unregulated, be very careful indeed. So for most private investors, you don't need to do that sort of thing. So you come back to the likes of gold and you come back to some commodity funds and things like that. That does give you a diversification. Yes, gold is old, but it's been an investment process. And one people always love to tell you it's held its value since Queen Cleopatra ruled. Well, I wasn't around then, so I don't know. But nonetheless, it is a perfectly good. And you don't actually have to buy the solid stuff either. You can just buy an ETF on it. And
okay, so one other area that was always interesting historically is a buy-right strategy. So you own the underlying security and you sell call options above, okay, but it's covered so that you potentially, okay, you're bringing in income. If the shares do go down, you're getting basically, you're eating like a pigeon. That's quite sensible, isn't it, in a bear market?
Yeah, that is very sensible. But for most private investors, they're probably not very au fait with that sort of structure. That's what...
Well, my tip, my call of action to people would be, okay, don't be scared of options, okay? If you see naked or you're writing options, put options and the likes, be very, very afraid. Understand what you're doing, but selling call options against the underlying is very straightforward.
What you're doing is effectively providing yourself with a level of insurance.
Yeah, absolutely.
And that's how people should try and look at options and futures.
Yep.
You can do the same with currencies. All you're doing, and I certainly do that in our portfolios, just to make sure I've got a level of support, but currency particularly, when we've got someone like sterling, where you need to have a top and bottom because it does move an awful lot. When it comes to the call options, though, on good quality stocks, you won't get them on all stocks. That's a very good alternative way of going about it. But it is just adding another layer of complexity. Learn about it first, try it out.
Yep. In terms of sterling, okay, one of the headlines I saw, fund managers and hedge fund guys were moaning like hell, saying getting involved in cable was impossible. Okay, you couldn't read it. There was so many geopolitical, political, inflation, interest rates. Mr. Carney, okay, how, as a manager of money, okay, how can you factor in sterling's behaviour?
It's incredibly difficult. You only have to take what happened at the Brexit vote. At the Brexit vote, we knew what the result was going to be because Ladbrokes told us we're staying in. So it was fascinating. On that day, we were having that discussion, and my chief investment officer said, yeah, but that's not the risk, is it? The risk is we vote to go out. Yeah, that's not going to happen. He said, no, we're here to manage risks. So he actually took out cover at 125. Right. Remember, we were at 150.
Yep.
And they stayed up all night just to cover the position and watch it. And of course, it did go down to 125. It did diametrically the opposite. So that just underlines how volatile this can be. Immediately after Brexit, it was going to get worse, wasn't it? actually. No, we saw it go back. It's back up to 140 now.
One-way business.
Yeah, but again, that was going against the tide. So the trouble is sterling is not in control of its position. It is a relatively small currency in comparison to the euro and the dollar, so we're bouncing in between them. And so depending on what they do, we reflect. So often it's not necessarily sterling strength or weakness, it's what's the dollar doing, and we're being dragged with it, not to say the same way. So all you can do is really try and hedge it back wherever you possibly can. For most private investors, there's not a great deal you can actually do. But I would always prefer, as a sterling investor, to have more of my investments overseas, because generally sterling has been weakening if you take a longer picture. If you think sterling is going to strengthen in the medium term, then you take an opposite view. But I would always have a broad range of investing. Now, good news for private investors, the FTSE 100, as we know, isn't a UK market. It's 70% turnover overseas. So you're actually getting pretty good global exposure just with a lot of those FTSE 100 members. So if you don't actually want to take any currency risk at all directly, because obviously you're taking it indirectly, because those companies are they are getting their income overseas, then you can just stay with the UK market. You have a simple choice.
I've got to ask you one final question. Okay, Mr. Donald Trump. Okay, if you could give him some advice, what advice would you give him?
Shut up, please, shut up. He's his own worst enemy, because the American economy is doing well. And the whole structure of the American economy, of the American constitution, is to make sure he doesn't have so much power. He's actually quite constricted. You've got a Congress which has a reasonable idea what needs to be done to try and control the debt. They want the growth to keep going. What you don't want is geopolitical stupidity, which is what we're seeing now with trade wars. All of this can be avoided. So if he just shuts up and let the world get on with it, like most countries, get the politicians out the way, it's astonishing how well they do.
On that note, Justin, always a pleasure.
Thank you
very much indeed.